Oh, this is a shooting star, so the reversal is starting. RSI is oversold, so now the asset is cheap. Price broke the level, so the breakout is confirmed. On a real chart, that is not enough. You can know candlestick patterns. You can use RSI, Elliott Wave, you can use a lot of other indicators and still read the chart incorrectly. The problem is not that you have too few tools. The problem is that each tool is used separately, without a system. The same signal can be useful in one location and completely misleading in another. It depends on the higher time frame, structure, location, confirmation, and risk. So in this video, we will break down 9 real charts, including Microsoft, silver, Bitcoin, and other examples, to show how technical analysis becomes a working system instead of a random collection of signals. In my working process, technical analysis is not the first step. First, I do a research and build a pool of companies or assets. Then comes fundamental analysis: the business, company quality, financials, risks, and the broader idea. Only after that, I move to the third stage, technical analysis. Trading alone makes unclear charts harder to interpret. Conflicting signals make you second-guess your analysis, and often there is no one to challenge your view. Sometimes you do not need another indicator. You need a second perspective. This is why I created a free Discord community for beginner and intermediate stock traders. Ask questions, discuss daily and weekly charts, and compare different interpretations. Scan the QR code or use the link in the description to join. Let's start from Microsoft. This is a good example of why you cannot read the chart by candles alone. This chart clearly shows why one bearish candle does not break a trend if the broader structure is still holding. If a bearish candle appears on the chart, it doesn't mean the trend has to reverse. A candle can show local selling pressure, rejection, or exhaustion. By itself, it doesn't tell us that the entire bullish trend is already over. Here on the Microsoft chart, bearish candles appear, then another one, then another red candle. If you look only at candlesticks, you should conclude several times that price should now reverse lower. But now let's add a second layer. Let's add a rising channel. And the picture changes immediately. Yes, individual candles look bearish, but price is still moving inside the rising channel. The channel is not broken. The trend remains bullish. That matters more than one candle. In my hierarchy, the channel structure of price is more important than a single candlestick. A candle can give a small warning, but if the channel is still holding, I cannot say that the trend is broken. Now let's look at another part of the chart. Here the situation becomes more interesting. Price had been inside a rising channel for a long time. The move was strong. We are approaching the upper part of the channel, and now we can add another layer of the analysis: Elliott Wave. If we read the chart through the wave structure, we can assume that the third wave may already be approaching completion. at least the move starts to lose its previous pace. Local pullbacks and signs of slowing start to appear, and in this zone, a strong bearish candle appears. This time, it is not appearing randomly inside a normal bullish move. It appears after a long advance near the upper part of the channel. We still cannot say that one candle guarantees a reversal. It can still become a false signal, but the important point is different. Now the candle is not alone. There are already other warnings around it. In this case, the candle didn't work as a part of the broader warning. After that, price dropped around 30% and moved into a more sideways structure. This is exactly how I use candlesticks, not as a system, but as the lowest layer of analysis, which only makes sense after more important things: the trend, the channel, the wave structure, and the broader behavior of price. Now let's move to silver and SLV. This example matters not because there is one beautiful signal. It matters because it shows how technical analysis evolves and the chart develops. We are not looking at one candle or one indicator. We are gradually adding layers and watching how the picture changes. First, an important point about timeframes. The higher the time frame, the more weight it carries. Monthly is more important than weekly, and weekly is more important than daily. If a large structure is forming on the monthly chart, the daily chart often fits into that bigger picture. So first, I want to understand the broad context, and only then I move to lower, to look at entry area, risk, and price behavior. On silver, the higher time frame had a large structure that looked similar to a cup and handle. That doesn't mean the pattern itself already gives a ready entry, but it does mean that the asset deserves attention, because a large potential structure is appearing on a higher time frame. Now let's move lower on the SLV daily chart. Here we get a strong candle. It appears with volume, breaks an important moving average, in this case the 250-day moving average, and appears after a local pullback inside the bigger silver idea. If we already know that there is a cup and handle context on the weekly or monthly chart, then this daily candle becomes more interesting. It shows that buyers are not appearing in a random location, but inside a larger structure. Let's say that here we are considering an entry or starting to build the idea. What happens next? Next, we get an almost full-bodied candle. It has volume, and price approaches the previous high. Many beginners start taking profits or exiting in this situation because they see that the price has already reached a high, so they assume resistance must come next. But that is not always the right logic. In this case, the attempt to approach the high on volume itself a very bullish signal. Price opens with a gap, prints a strong candle, volume comes in, and the market starts testing the previous high. In other words, the buyer does not disappear near the level. Instead, price shows upward pressure. Now let's see what happens after that. Price breaks the previous high and makes a higher high. But the important part is not even the higher high itself. The important part is how price tests it. We can see price returning to this zone, and that move being bought quickly. The candle leaves a long lower wick. That tells us there was an attempt to push price lower, but the market didn't accept it. At the same time, volume on the test is not as large as it was on the breakout. That is also important. When price tests a level, there is no major selling volume. And then price quickly continues higher. It can suggest that strong resistance is no longer present there. After that, price continues to move higher. Again, we see large, full-bodied candles. Again, volume appears. For me, this is another confirmation that the move still remains bullish. At this stage, it becomes clear that the price is starting to move inside a defined channel. At the same time, I watch the moving average, because they help show where the price remains inside a healthy trend. Next, we can add Elliott Wave. We adjust the channel slightly and start reading the move through the wave structure. First, we have the first wave, then comes a correction, and after that, price continues to move inside the channel. Volume appears from the time to time, but the main thing remains. Price is still moving within the channel. The channel structure is not broken. You can also see here that the price often tests moving average and bounces from it. That doesn't mean the moving average is a signal by itself, but it helps us see that the buyers continue to defend this dynamic area. Then price reaches the upper boundary of the channel and a small correction starts. That is a normal behavior. If price reaches the upper part of the channel and pulls back from it, it doesn't mean the whole trend is broken. No. At this stage, we can continue mapping the Elliott Wave structure. We can see that after the correction, price still remains inside the channel. Then another correction appears, which can be viewed as a fourth wave. After that, the advance continues. And again, the important point is that the channel is still not broken to the downside. So as long as price is moving inside the channel, the structure remains valid. Now let's see what happens next. Price breaks above the channel. Usually, these upside breaks from a channel often happen closer to a buyer climax. This is not always an immediate reversal signal, but it is an important change in the character of the move. Here we are moving into the final fifth wave. In an Elliott Wave fifth wave, this often happens. Price moves above the channel, acceleration begins, euphoria appears, large volume starts to come in, and strong full-bodied candles appear. In that moment, the move looks very powerful. But that is exactly why we need to be more careful when we see an extension in the fifth wave. If the extension didn't happen in the third wave, it can often appear in the fifth. And here we can see that the final part of the move becomes very aggressive. Then a candle appears with large volume and huge upper wick. This is not necessarily a textbook shooting star, but in meaning it already looks very similar to a warning. Price opened high, buyers tried to continue the move, but sellers managed to push it down. And the important thing is not only that this candle exists. The important thing is that before this, the full-bodied candles had already started disappearing. The move became less clean. Price had moved very far away from the moving averages. The distance became too large. For me, this is one of the stronger red flags. When price moves very far from its moving average, it doesn't mean it must immediately fall, but it tells us the move has become stretched. The risk of a correction increases sharply because the price has moved too far from its normal base. We see the final result in the next section. A sharp correction happens. Price drops from around 110 to 70 in one day. This already shows that the final part of the move was overheated, and the market couldn't hold such a vertical structure. From Elliott Wave, we know that after an impulse is complete, a correction often moves back toward the area of the previous third and fourth wave. This is not an exact level and not a guarantee, but it is a normal zone to track. Now let's look at the volume clusters. First, there is a cluster around 95 to 100, from which price fell sharply. The price broke that cluster and moved lower. Below that, there is a zone around 75 to 85. Then price spent a long time moving around the 60 to 70 area. Now the price has moved lower, and the nearest strong cluster is roughly in the 40 to 50 area. From a volume profile perspective, this is the next major zone price could theoretically be drawn to. And importantly, volume profile and Elliott Wave begin pointing to roughly the same area. On top of that, price has already made a lower low, and the correction itself is starting to look like a WXY structure. If this is really WXY, then the Y wave can be fairly long. So the correction scenario into the 40 to 50 area looks logical here. Not as a guaranteed target, but as a zone I would watch closely through structure. Let's simply summarize what we used here. We used timeframes, chart patterns, Elliott waves, channels, moving averages, volume, and fixed range volume profile. All of this was used on one chart, and this is where you can clearly see how each tool complements the others, adds information, and helps analyze the current situation through several layers at once, not through one signal. Now let's look at Lyft. This example is useful because it shows that even when a setup looks good, it can still fail. And the job of technical analysis here is not to predict everything perfectly in advance. It is to notice when the structure starts to break down. First, let's look at the bigger picture. From its high, Lyft fell by roughly 87%. That is a very large decline. In my experience, if a company falls more than 90–95%, that is already a very serious risk zone. In that area, there may often be problems with the business, financials, dilution, debt load, or even a risk of that the company may not be able to recover properly. But after the decline, Lyft started to show signs of life. First, price stopped simply falling and started moving in a range. It stopped making constant new lows. That is already important. Second, small higher lows started to appear. Third, price made a higher high. So after a strong decline, there was an attempt at stabilization. Price moved into a range, started holding lows, and then broke a local high. Technically, this can already start to look like the beginning of a repair structure. Now let's look at the gaps. There is a large unfilled gap on the chart roughly in $20 to $30 area. I'm not saying that a gap has to close, but technically this kind of zone often becomes an important reference point. If the structure starts improving, price may try to return to that area. Then a smaller gap appears below and price moves to close it. And this is where the setup becomes interesting. We made a higher high, then retest this area, closed the gap, and moved higher again. So the current structure looked very bullish. Range, higher lows, higher high, gap closure, and an attempt to continue. But then the problem appears. At the high, a candle forms that looks like a shooting star. It doesn't have to be a perfect textbook form, but in meaning, it is a warning. Price made a new high, but it couldn't hold the move higher. After that, price starts to pull back. At first, this can be read as a normal pullback. In a good setup, a pullback is not a problem by itself, but then we need to watch what happens to the structure. Here, the pullback starts to deepen. Price does not hold previous zones, momentum weakens, and the decline becomes serious. From the high, price falls by more than 50%. That is no longer a small correction. That is a serious deterioration in structure. And here it is important not to completely write off the company immediately. The first setup didn't work, and that is normal, but we have to recognize that the technical picture has changed. Now let's look at the new situation. We have a support line that can be drawn through the lows. As long as price holds this line, the structure can still be monitored. But if this line breaks, this is a different signal. If the fundamental side worsens at the same time as the technical structure, the setup becomes much weaker. Now let's add volume profile. Because price spent a long time in a range, the point of control area becomes important here, meaning the area where the main volume traded. Right now, price is near that volume area or slightly above it, and this is an important point. In corrective structures, especially if we are considering a zigzag, the B wave can often form near the area of maximum volume. The market trades sideways for a long time, creates the feeling of stabilization, but later that zone may turn out not to be the start of a new trend, but the middle part of the correction. Technically, this could be a zigzag. If it really is a corrective structure, price can move significantly lower. And then we are no longer talking only about a failed setup, but about the risk of another strong move down. If the decline continues and the total drop from the high reaches 90 to 95%, then for me the company moves into a completely different risk category. At those levels, I actually no longer view it as a normal rebound setup, because the market may be pricing in very serious problems. The main lesson from Lyft is this. The setup looked bullish. There was a range after a strong decline, higher lows, higher highs, gap closure, and volume. But then warning signs appeared: rejection at the high, no continuation, deep pullback, and structural deterioration. So a good setup doesn't have to work. If it doesn't get follow through, it needs to be reviewed. If the structure breaks, the scenario has changed. Lyft shows that technical analysis is not only useful for finding a clean entry, it is also useful for seeing when the idea is not confirming and risk is becoming too large. Now let's look at Powell. This example is built around one important idea. A higher high does not always mean the trend is simply continuing. Sometimes a higher high appears inside a corrective structure and can be misleading. First, let's take a look at the left side of the chart. For a long time, price is moving sideways inside a defined range. It is not really going anywhere. There is no strong trend, no real acceleration, and the market is simply moving inside a limited area. Then an important movement happens. Price breaks the current high with a gap, a strong candle, and volume. That already looks like a fairly strong bullish signal. We have a gap, volume, a break of the high, and all of this happens inside the rising channel. After that, price returns to this zone and tests it. Price doesn't fall back below the level. The level holds. As long as the channel holds, the structure remains valid. But then a more interesting part appears. Price breaks the channel and moves sideways. This is where we need to be more careful. If a strong move higher is over, price has left its normal channel structure and started moving sideways. That can be the beginning of a correction. and shortly after that price makes another high. At first glance, this can look bullish. A beginner may say price made a higher high, so the trend is continuing. But in this location, the higher high is not as clean. Why? Because before that, price had already left the channel. In other words, the normal impulse move that was moving inside the channel has already lost its previous structure. And if another high appears after that, it needs to be read more carefully. From an Elliott Wave perspective, it is logical to consider that after a strong advance, a fourth wave may be starting. A fourth wave often develops as a sideways or a complex correction. Sometimes it can be a sharp correction, sometimes a flat structure. And if price makes a new high inside that kind of correction, one logical possibility is a running flat. In other words, price makes an A wave down, then the B wave rises above the previous high, creating the feeling of a trend continuation, and then a C wave down appears. That is essentially what we see here. Price makes a new high, but this higher high turns out not to be the start of a clean new impulse. It is start of the correction. And after that, the C wave forms, price moves down, and only then does the market continue into the fifth wave. This is the main lesson from Powell. A higher high by itself is not enough as a signal. If a higher high appears inside a healthy rising channel, after a breakout and a successful retest, that is one situation. But if a higher high appears after price has already left the channel, moved sideways, and the structure starts to look like a fourth wave, that is completely different situation. In that location, the higher high may not be continuation of strength. It may be the B wave inside a running flat. So I don't want to read the chart through the simple formula. Higher high means bullish. I want to understand where that higher high appeared inside an impulse or inside a correction. Powell shows very clearly that the same element can mean different things in different parts of the chart. Inside the channel, the higher high confirmed the move. After the channel break, the higher high became suspicious and turned out to be the part of corrective structure. Now let's look at Bitcoin. This example is important because it doesn't show one ready answer. It shows the process of building scenarios. When price breaks a long trend, we cannot simply say, that's it, now it is definitely going down. But we also cannot ignore the fact that the break happened. We need to look at how price broke the structure, where there was a retest, what scenarios remain, and what Elliott Wave and volume profile are showing. First, let's draw a trend line. But this is important. I do not treat a trend line as one perfectly precise thin line. I treat it more like a zone or a support area that price can test not at one exact point, but across a region. Price came into this rising area many times and bounced from it again and again and again. First test, second test, third, fourth, fifth, sixth. So for a long period, this zone worked as a support. Price kept returning to it, testing it, and moving higher again. That means this was not a random level. It was an important rising structure that supported the entire trend. Now let's see what happens next. Price breaks this zone. And the important thing is not only that the break happened, the important thing is how it happened. Price breaks support on strong candles with clear momentum, then returns to this zone from below, tests it as a resistance, and after that moves lower again. This is already a serious change in chart character. As long as price was simply moving into this zone and bouncing, the trend remained valid. But when price broke the zone, retested it from below, and couldn't get back above it, that suggests the 3-year uptrend most likely ended. But there are still several scenarios. The first scenario, this could have been a false breakdown. Price could have broken the trend line, then quickly returned above the zone, and then we could treat that breakdown as false. But in this case, price didn't return back above it. It broke support, retested it from below, and moved lower. So the false breakdown has not been confirmed so far. That leaves two main options. First option, price moves into a large range. Second option, a correction begins. To understand which option is more likely, I add Elliott Wave. If we look through the Elliott Wave, a large upward move may have ended before this, meaning the fifth wave may have completed. After the fifth wave is complete, a correction usually begins. Corrections can be different, sharper or more sideways. In this case, the move after the high looks more like a sharp correction because the decline is fast and impulsive. A sharp correction often takes the form of a zigzag or a double zigzag. Now let's take a look at the structure itself. From the high, the price has already moved down by about 36%. That is already close to a zone where we can talk about a fairly deep correction. In a classical sense, a sharp correction can often move roughly into the 38 to 62% area. Although this is not an exact formula and not a guarantee. Now let's look at the internal structure. First, there is a sharp move down. This can be reviewed as an A wave. During this move, price breaks an important support zone. Then there is a retest, but price quickly turns lower again. After that, a correction appears. This can be a B wave, but here we need to be careful. At the moment of the recovery itself, we cannot know with 100% certainty that it is a B wave. Theoretically, it could also be the start of a new upward move. So in places like this, I do not want to make a conclusion too quickly. We need to see what price does next. Then price breaks the low of the A wave, and that becomes an important confirmation. When price recovers and then moves down again, breaking the A level, the structure starts to look like a classic zigzag. In other words, we have A down, B up, and C down. That is already a sharp type correction. Then price completes the C wave and moves sideways. And here again, we get a fork in the road. Option 1, the correction is complete and the market starts building a new upward move. Option 2, the correction is not complete yet, and a normal zigzag can turn into a double zigzag. And now let's see what happens next. Price attempts to push higher, then turns down and breaks the low where the C wave may have ended, so we get a new lower low. And at this point, the structure starts to look more like a double zigzag. If this is a double zigzag, the first correction was W. Then the recovery became X. And after that, the market can move into a Y wave. Structurally, the Y wave can often look like another ABC down. In this situation, I can draw the OX line. This is an important reference line. As long as the price remains below this line, the structure remains bearish. To talk about a more serious upside reversal, price usually needs to break the line, retest it from above, and hold above it. Until then, I would consider the downward corrective structure still active. Now let's add volume profile. If we look at the volume from the previous move, we can see that the price has now reached an important cluster around 60 to 70,000, and it is starting to break through it. The next visible cluster below is around 40 to 45,000. That can be a logical area where the Y wave could theoretically complete if the double zigzag scenario continues to develop. If that zone doesn't hold, then the next large volume cluster sits lower, roughly in the 20 to 30,000 area. But this is important. These are not exact targets. These are zones I would track as a potential areas where price may react. Now let's look at the volume profile inside the downtrend structure itself. Here we can see that the point of control is roughly on the X wave. This is a classic feature in corrective structures. In a normal zigzag, large volume can often form on the B wave because the market spends time there and creates the feeling of stabilization. And here we see a similar logic. We have one volume cluster around the B wave area, then the structure becomes more complex. A larger cluster appears, and the point of control is now around the X wave area. This additionally supports the idea that this may not be just a single zigzag, but a double zigzag. The main takeaway from Bitcoin is this: a trend line is not a magic line by itself. But if price held a rising zone for 3 years, then broke it on a momentum, retested from below and moved lower, That is an important structural change. After that, technical analysis should not give one emotional answer. If price returns above the broken zone, we can consider a false breakdown. If price moves sideways, we can consider a range. If the structure develops through ABC and then breaks a new low, we can consider a double zigzag. And if volume profile is showing clusters, specifically in the B and X areas, that strengthens the idea that the market is inside a corrective structure rather than a clean new uptrend. We are not only trying to guess one candle ahead, we are looking at where the trend broke, where the retest happened, how the Elliott Wave structure is developing, where the volume clusters are, and under which conditions the scenario is confirmed or invalidated. Now let's move to Progyny, because this example is built around one simple idea: a volume cluster is not a signal. It is a planning zone. It shows where the market already traded heavily, but it doesn't tell us in advance where the price will reverse, break through, or continue chopping. In the previous Bitcoin case, we used technical analysis to build scenarios. Here, we are going to use volume profile to build a map. First, look at the bigger picture. Price had a large decline from the old highs, and then it started moving sideways in a much lower area. When a stock falls this much, I don't want to randomly guess the bottom. I want to know where the market actually traded volume. Now look at the volume profile. We can see several major clusters. There are areas where a lot of trading happened. I call them clusters. Technically, you can also talk about high volume nodes, and the biggest one is often the point of control. The point of control is simply the price level where the most volume traded inside the selected range. But here's the key. A cluster is not a buy signal. A cluster is not a sell signal. A cluster is a planning zone. It tells me pay attention here because the market already did a lot of business in this area. But now look what happens. Price keeps moving between these areas. We have a lower cluster where price finds support several times. Then we have an upper cluster where price keeps struggling. Price moves up into the upper cluster, rejects, and comes back down. Then it tries again, rejects again, and comes back down. This is the kind of chart that can destroy impatient traders. If you buy near the upper cluster, price rejects. If you panic near the lower cluster, price bounces. Progyny is not giving us a clean expansion yet. It is trapped between the participation zones. In this kind of structure, sometimes the best technical decision is not to force a bullish or bearish option. It is to wait for acceptance outside the range. This is also why support and resistance should not be drawn as one perfect line. These volume areas are zones. For me, it is a good example of patience. The chart has important areas, but it doesn't yet have a clean decision. And that is a real technical analysis answer too. Sometimes the answer is the chart is not clean yet. Beginners often think technical analysis should always produce a trade idea, but it shouldn't. Sometimes it should stop you from forcing one. Now I want you to show where RSI can actually be useful. Not on small time frames as a signal for every little reversal, but on higher time frames where an extreme reading appears rarely and can become an important context marker. I will say this right away. I usually do not use the RSI on small time frames. I do not try to catch every small reversal with it. I do not use it as a standalone signal, and I do not build the whole system around it. But on higher time frames, especially the monthly chart, sometimes it shows very interesting things. Let's take Adobe. Across the full available chart history, RSI moved into this kind of extreme zone only a few times. If we take this level of deep deviation, it doesn't mean that RSI falls into an extreme zone and you should buy immediately. It is not a signal by itself, but it tells us that Adobe is in a very rare state from a price momentum perspective. I wouldn't call this a cheap company in the fundamental sense, because valuation has to be analyzed separately, but from a chart and momentum perspective, this is extremely oversold zone. And these zones are worth marking. Sometimes these zones become important areas for a longer-term reversal. Sometimes price continues to fall or spends a long time moving sideways. So RSI doesn't give us a ready decision, but it says something unusual is happening here, and this stock deserves closer study. Now let's look at IJR. It is a small cap ETF, and the logic is similar here. Look at the history. Over the last 25 years, there have been very few zones this extreme. One of the strongest points was around 2009, when the market was extremely oversold. And the meaning here is the same. RSI does not say buy here. RSI says the market is in a rare oversold condition. For example, if I am already looking at individual companies, if the sector or asset group itself is in an extreme zone, that can give me additional context. But again, this is not only one layer. After this kind of signal, I still need to look at price structure, levels, trend, Elliott waves, fundamentals, and how price reacts after these extreme zones. The main takeaway here is simple. On small time frames, RSI often creates a lot of noise, but on higher time frames, especially the monthly chart, extreme deviations can be useful. Not as a buy signal, but as a rare context marker. After that, we still need to do a full analysis and see whether the structure confirms the idea or not. Now let's look at one of my favorite companies, DigitalOcean. This example shows the full cycle, a damage chart, recovery, impulse, and then a late stretched phase. First, let's take a look at the bigger picture. The company had a strong rally, after which price moved from roughly $130 to $19. There was a decline in about 85%, for an individual company, that is a very serious correction. The market is usually pricing in very serious problems. Growth expectations, margins, valuation, or confidence in the business. Now let's add volume profile. If we look at the volume at this decline, we can see several important zones. The main cluster is in around B wave. That makes sense because the correction itself was a sharp type correction, roughly ABC. In these structures, the point of control is very often located on the B wave, where the market trades for a long time and debates the value and creates the illusion of stabilization. There is also another smaller volume cluster lower down, closer to the lower part of the structure. Now let's take a look at an important local high. This is the B wave zone from the previous correction. Price approaches this level several times. First test, then pullback. Second test, then another pullback. On the third attempt, price breaks this level. But the breakout itself is not the only important part. After the breakout, the price makes a top-down retest. This is a very important moment. Before, this zone was resistance. After the breakout, it starts acting as a support. After this sideways range and a small correction, price starts to form a clear impulsive structure. What do I mean by impulsive structure? Price stops moving randomly inside a range and starts moving within a channel. Before this, we had sideways movement. Now a small channel structure appears. We can draw a rising channel and we can see that the price starts respecting that structure. Then price returns to this zone again, tests it from above again, holds it, and only after that starts moving higher. This is already a strong change in structure. We had a damaged chart, then there was a consolidation, then price broke an important B zone, tested it from above, and held it. This already starts to look like a repair structure. Then stronger candles begin to appear. We see several large, almost full-bodied candles in a row. This shows that buyers are buying more aggressive. Price is no longer just recovering slowly. It is starting to accelerate. At this stage, we can add Elliott Wave. If we break the move down by waves, we can see that the structure is developing as impulse. And in this case, it is especially important that the extension appears to be happening in the fifth wave. This is the same point I mentioned in the silver example. Very often, in the final fifth wave, price starts to break out above the channel. And here we see a similar picture. While the move was healthier, price stayed inside the channel. But in the fifth wave, it starts moving above the channel, accelerating and separating from its normal structure. At first glance, this looks very bullish. Price is rising fast, candles are strong, and momentum is high. But this is exactly where we need to become more careful. Look at how far price has moved away from the moving average. The distance has become very large. Just like with silver, this distance by itself doesn't mean price must immediately fall, but it shows that the move has become stretched. Now let's look at candle behavior. Before, there were large full-bodied candles showing clean buyer pressure. But closer to the upper part of the move, the picture starts to change. More wicks appear, more tails appear, and the channel behavior becomes less clean. The price can still make new highs, but the impulse itself already looks less clean. For me, that is a warning, not because one candle decides everything, but because several things appear at the same time. The fifth wave, the break above the channel, a strong distance from the moving average, fewer full-bodied candles, and more wicks. It already looks like the impulse is starting to lose energy. Now if we zoom out slightly, we look at the entire move more broadly. We can see another interesting structure. A pattern similar to a cup and handle starts to form. But there is an important caveat. The cup does not yet have a proper handle. Price has already moved to the cup level and even broken it. So this is not a classic textbook version. Real charts often do not form patterns perfectly, so I don't want to call this textbook cup and handle, but the idea is possible. One scenario is this. Price could move lower, test the breakout area, close the gap around $105, then form a consolidation, move back to the cup level, and only then bound the handle. Price may also fail to form a handle and simply continue higher. So the point here is not to guess one version in advance. The point is to understand that after this kind of distance from the moving average and after moving into a fifth wave, correction risk is already higher. The situation is very similar to silver. We saw when price moves far away from the moving average, breaks out of the channel, becomes vertical, and starts showing signs of buyer euphoria, that often ends with a sharp correction. In silver, that correction was very fast and strong. In DigitalOcean, we do not yet know whether the reaction will be the same, but the structure is warning us. This is no longer an early move. This is a late stage move. So the main takeaway from DigitalOcean here is, first, we had a damage chart after a decline of roughly 85%, then volume profile showed important zones, including the point of control around the B wave. The price spent a long time in consolidation, then it broke an important B zone, retested it from above, and started to recover. Then an impulse move appeared inside the channel. Then in the fifth wave, price started breaking above the channel, moving far from the moving average and showing signs of overheating. And now we shouldn't simply celebrate the rally. We need to watch where the price starts forming a correction, a handle, or a deep pullback. DigitalOcean clearly shows that technical analysis is not only useful for seeing a recovery. It is also useful for understanding which phase of that recovery we are in: early repair structure, healthy impulse, or already a late stretched phase. The main idea of this video is simple. Technical analysis is not one candle, one RSI reading, or one pattern. Every tool can help, but every tool can also mislead if it is used in isolation. That is why I always read the chart in layers. First, the higher time frame, then I move lower, then I look at structure, location, signals, and confirmation. Only after that does it make sense to talk about risk, because technical analysis without risk is just a nice chart story. Before you go, tell me which part of this video was most useful and which part still feels unclear. Was it candlesticks, Elliott Wave, volume profile, or the way these tools work together? Leave your question in comments. I will use your feedback to decide which topics need a separate, more detailed video.